here and then a flat like that, just to hold, you know, it could be like that. If it's the same as this, see, down, up, and then flat, we have to just see how that, this is just one shape of how it could look. So we just have to see, but these flat ones are really nice. I like the flat ones, and usually the flat ones are a bit longer. And obviously then you have deep ones, which are corrective, but that would also work too, because then you're just looking for some kind of corrective ABC to go up. Hi B, how's it going? Yeah. So in terms of, like, I don't want to go on too long about this, but the idea that I shared before about the bull run was continuous buying. And I think this, I don't know if that's, if people are familiar with that idea, because when the price is when the price is going down, if you buy, you're always underwater. And you may end up with an average position eventually quite low when the price reverses, but no one really knows when the price is going to reverse, and no one really knows how far the price is going to go down. No one could have predicted how far this was going to turn. This could have continued all the way down, and so that's why it's very difficult to just buy against the trend. It's always better to go with the trend. But now that the price is looking to turn, I think people should be less, like, not so fast with trying to take significant profits, because if this is a trend reversal, then this trend, if I showed you the pitchfork that I drew before, is it on this chart or is it on the other chart? No, it's on the other one. It's on my gate chart. There, and I'll get rid of the rest. This is just an idea. I don't know if this is going to play out, right? And so if you wanted to draw that for yourselves, it would be from the first significant all-time low to the first high in that rally to the all-time low. And I've probably done it on the 3-day chart because the pivots don't look so, or maybe even the weekly chart. I can adjust it to the 3-day so we get more accurate points. Doesn't really matter. It's all a kind of, these lines are always range. They're kind of zones less than, you know. So I mean, if you can imagine the trajectory of the price as described by this pitchfork, then you are buying. You're not really selling. Why would you sell into that trajectory if that's the trajectory of the price? If we do start to kind of make our way, you know, somewhere up and down in this pitchfork, then by the time you sell, you've got nothing. You're out. You've literally got zero at the end. You keep on selling. So ultimately, what you will be doing is you're looking to sell to buy back in, to compound, because in the same way that we had this extended downtrend, we could now have an extended uptrend, and that's the change in behavior that we're looking for now in this token. And initially, that change in behavior is going to be evident by the turning of the moving averages, the higher time frame moving averages. So as you can see right now, we are just above the 3-day 200 simple moving average. Has that ever happened before? No, look, it's never happened before. This is the first time in the token's history. If you can imagine, when the token launched, this moving average didn't even exist, but you can see it was probably much higher. if it did exist, and this is the first time we've actually been able to potentially, well, we got above it in that candle, but look at where we are. So what we're in the process of experiencing is the turning of the moving averages on the higher time frames. And obviously on the daily time frame, I've shown before that we've had a golden cross. We had a golden cross before here, so this is the second time we've had it, but the circumstances are very different now, and that indicates the turning of the tide. The momentum is shifting from a downtrend to an uptrend, and what we really want to start seeing is all of the time frames to fall in line with that idea. So the next time frame, I mean, you could, you know, every time frame has a time frame. So you got the 2-day time frame. Sure, the 2-day time frame is about to happen. Then you have the 3-day time. Like I use all the time frames, but most people use 1, 3, and week. So let's just go based on what most people use. And then obviously the week is, we don't have a 200 average yet. But what's interesting about the weekly time frame is we're now above the weekly 50 simple moving average for the first time. That is really fantastic to see. That's like really amazing to see, because once we clear this moving average in terms of price and we hold it as support, I don't think many people expect the price to come back underneath it for the duration of the bull market again. And if the price does come back to the moving average and the price is going up and it comes back down, then obviously forget about this pitchfork. But you would expect the moving average to offer support in some meaningful way. So then that brings me down to, how do you accumulate during a bull run? Because I'm suggesting that people buy. And so I think there are different ways of doing this. And I think the easiest way will be simply to pick a time frame as we move up, and to, when these red candles close, you accumulate, you only buy the red candles. Now, some people don't want to look at the charts on a daily basis, and that's fine. Then you can just focus on the weekly red candles, and you may not be buying as frequently, but then you might take bigger chunks out of the price. So you may go, the next time I see a red weekly candle, I'm just going to buy 100,000 TRVL, bam, on the close. Yeah. And that you could approach it like that. And I don't know how many red candles we see, but at the very least, if you buy red candles, then you're buying after the sellers have sold. You don't want to buy before the sellers sell. You want to buy after the sellers sell. You want to buy when there are people are still selling. Basically, that's what I'm saying. You want to buy once they've stopped. So a good strategy would be just to focus on a specific time frame that suits your life, and allocate your positioning based on the frequency of the candles. And then when you see a red candle on the close, that's when you would buy. You'd keep on scaling on the red candles. And as I've described before, you can actually skim profit from the green candles. So if you don't have the spare capital, then over time you could skim from the green candles with a view of putting it back into the red candles. Now, you can't be greedy when you approach it like that, because, you know, and I'll explain why, because you may end up buying higher. That's my point. If we're going to get like a green candle and then a green candle and a green candle, like 3 in a row, and you've skimmed some from the top of each candle, yeah, you're skimming profits. So your overall position is reducing in terms of TRVL, but obviously increasing in terms of USD value. And then imagine that we now consolidate, but the consolidation is a really flat consolidation. So we've made 3 weekly green candles, 1, 2, 3. And then we have a flat consolidation of 3 red weeks, whatever. So you've skimmed from these candles, you're actually putting the value back in higher up. Yeah. So in terms of TRVL value, you're still less, but the idea is still correct, because what you're doing is you're buying after the sellers have exhausted. You're accumulating back in, you're putting the money back in after the sellers have diminished. And even though you can't be greedy when you act that way, because it's just playing it safe, because you don't know how the red candles are going to correct. You don't know if we get 3 green candles going up, we don't know if the next 3 candles are going to be all the way down here. So you just don't know the future. We don't know how this is going to play out, how corrective these candles are going to be. You won't know if a candle ends up higher or lower than your position. The most important thing in this kind of technique is consistency. The consistency in terms of the value that you extract and then put back in, and consistency in the approach. So if your approach is to take a little bit from the green candles and put it back in on the red candles, you have to make sure that the time frame is consistent, the amount is consistent, and it's consistent in the execution. Does that make sense? And that is one way to approach the bull market, the expansiveness of the price. Yeah, it's a very easy way to approach it. You can't be greedy, because you're not trading. You just have a really systematic way of, okay, it's a green candle, it's a good time to skim. Oh, it's a red candle, it's a good time to put it back in. And even if it doesn't work in your advantage in the long run, you're actually helping the token in the long run. You're helping if everyone behaves that way, then everyone is helping each other. It's like a collaborative effort to defend the price as the price comes down, and then you always have capital to put in because you are skimming from the top, so that the volume that goes up is healthy too. It's not a low. We don't want to see a low volume rise. So in that respect, it's always good to take profit with a view to putting it back in, compounding it back in. That's one approach. Another approach which could work for certain people is, did I lose my I lost my simple moving average. Oh, it's because it's on the other chart. So if I actually lost it. It's weird that I lost my simple moving average. Why did it do that? It's so annoying. Let me put it back in. 50. I want it to be yellow. Don't know why, but I like the 50 to be yellow. What you could do is you could just wait for the price to come back to the 50 moving average. And it doesn't have to be the 50. A lot of people have their preferred moving average. It doesn't really matter. And I think the 50 is, for me, the 50 is a good one because it's nice and slow, and I just like it. I like it because in Forex it works quite well, and I don't know why, but you can use any moving average really. But ultimately what you're doing is you're waiting for the price to come back to that moving average. So at the moment on the daily time frame, it's amazing, but when you look at it in hindsight, you look at this expansive push up. Look how it came. You see how it's already offered. I mean, it's almost like it hasn't touched, but you see that and that. You see how the 50 is actually offering support. See, one, this is twice. So when you see that kind of behavior, and then when you see in the past how the 50 did offer support, it did offer resistance, it did offer resistance, it's now offering support. Yeah, it's just a very easy way to enter without too much thinking, without too much thought. Yeah, and you could just wait every time the price comes back to the 50 moving average to keep on adding. Yeah, now the daily is obviously it's starting to offer support, but I don't know how I can't predict the future. I don't know when the price is going to come back to the 50 again. I obviously don't want it to come back anytime soon because I want the momentum to pick up. And so I know, like, I know in other trading groups they use another moving average, and I'm going to just add it now to see how that fares. And it's the EMA 12. So let me just add that. I haven't added it in a long time, but so this is the first time I'm actually looking at it. I'll put it up as like some kind of step line so we can see that it's different. So on the daily, it's hard to tell. So let's go to a lower time frame. Yeah, I can't tell you if it's good or not. It's a hard one. So it's actually quite interesting. So looking at previous price action, look at this downward move. The EMA 12 clearly offers resistance here and here. Potentially also here. And then when the price does get back above the EMA 12, it does offer support here until it loses support, and then it basically kind of holds the price down, kind of. So now we're back above it. And when you look at this, this is the weekly time frame. When you look at this, you can see that it is offering support in some way. It is looking like it is. Now, I don't know if it's the EMA 12. It could be other factors. It could be other moving averages. It could be other ideas. But they seem to coincide sometimes. And that's what's interesting about certain moving averages. Obviously, on the 3-day, it looks like it did once and then it didn't until it did again. Until it didn't, until it did again. You know, like it's hard to... There's no rule for this. So it's just an idea. And usually with the EMA, like the EMA 12 or something like that, it's not really to buy, it's almost to sell, it's almost to take profit. So what I know that certain people, what they do is that when they get a loss, when they lose the EMA 12, like there, then they'll take their profit when it comes back to it the first time. So they use it as a take profit. So they might use a combination of an EMA to take profit and a higher time frame SMA to add back in. Now, everyone has a different strategy, and I don't have the answer, but there are different ways of doing this. And then the other way that could potentially work for certain people would be the Bollinger Bands as well. And so kind of what you're looking for is to skim profit when it goes into the outer regions, when it crosses the top, and then you're putting it back in on the middle. So your midpoint is where you're trying to get it back in. So as it extends beyond the band, that's like overpriced. And then when it comes back to the band, you're trying to get it back in. I think the most important thing you do is that you determine your own idea of what you want to do. and be very consistent in how you do it. But it's the same for all of us. What we're all trying to do is to try and to compound. We're trying to take profit, to put it back in and defend the lows. And I think the more and more I do videos, I'm just going to keep on repeating that idea, just quite simply because new people will come and they have to hear it, you know, because I don't think a lot of people know what to do and how to do it. The other thing that I think is not a bad idea, especially when you're forming ranges like this, are the volume ranges. So what I do is I draw from the candle that enters the volume, the new range. I'll use this tool, the fixed range volume profile, from that first candle to the current price. And then what you can do quite simply is trade the range. So you're looking to skim at the top, which is this top blue line, and then you're looking to put it back on the lower part, or the point of control. And ultimately, what you're hoping for over time are higher lows, higher lows, higher lows, to get the squeeze to go up. Yeah. So at the moment, we're not really, but we haven't ranged enough to be able to determine what's happening. And this is usually what happens after some kind of explosion. The price needs to settle, it needs to figure itself out. It needs to form some sort of range. And then we can start seeing if anything is forming in the price to determine what could happen later on. I think quite simply the way you should approach it maybe is, well, look, yesterday's close was really nice. It was slightly increase in volume on the previous day. The red candles were decreasing volume, which is what you want to see. And you saw an inverse hammer, this red inverse hammer in the lows, which is a reversal candle in the lows. An inverse hammer in the lows is a reversal candle. So that's kind of what you want to see. This whole structure is the beginning of a reversal structure, but you would need another green candle for confirmation, right? So we have to see if that happens, but that would be nice to see. And obviously this daily close yesterday, closing above this wick and also above this previous candle open here, is what you want to see. That's a good sign for a bullish reversal. Obviously, if the candle had closed, potentially if it had closed above that wick, it would have been better. You have to bear that in mind. But it closed above the open, so it was good enough. And what usually happens, which is what I'm seeing now, is that the price is trying to come back and test this wick here, which is normal candle behavior. It's very normal for an expansion for the price to come back to back test something in the price, and that usually corresponds to volume gaps. So when the price comes up, it's because the price gaps over certain levels because there's no volume. And so let me see how much this candle volume was. It was quite a heavy candle. Look at that, 459,000. That's a pretty decent handle. And we have a bit of a profit take there. That's a 269,000. And this is quite a nice candle. This is the beginning of a reversal, but you have to see, so the confirmation would be another green candle. So we have to see how that plays out. But you kind of want a back test. And so when you have an expansion like that, this is your expansion. And if I use bars so you can see, then I can do this volume pool on these three candles. And you can see that there are gaps. I mean, it's very hard to see, but there are gaps. There's like low volume on the way up. There's a little bit of volume here, a little bit of volume here, a little bit of volume here, and then some significant gaps. And so what you'll get with the price is when you form gaps in the volume, the price will try to fill those gaps. It's just the way the price behaves. The market doesn't like gaps in volume and price. And so when you get this candle to come back down, what it's actually trying to do is it's trying to fill all of the gaps, and it's trying to get all the way back down to this red candle here. That's what it's trying to do. It's trying to come all the way back down to continue. Yeah. And depending on how many limit orders there are and how many sellers there are and where they're looking to sell to, etc., will depend where the price comes to. But here you see it looks like it's trying to get, potentially the top of this candle is offering support, potentially, or maybe this candle here is offering support at the moment, maybe. So naturally, a good way to enter the market when you see this kind of behavior would be the bottom of wicks, and then to take profits at the top of wicks. So that's also an idea that you can have in mind, and you just have to find a method for yourself which you're comfortable with, and just keep it consistent. But you see how here the price comes underneath these wicks. So people are like, when shall I enter? When shall I enter? Well, the price comes underneath this wick, this wick, this wick, and then this finally holds. But naturally, when you're looking at the price, where was the best entry? The best entry was at the bottom of the wicks. So that's also something to bear in mind. If you're looking to enter, the bottom of the wicks are pretty good. And the top. The bottom and the top of wicks are really good. And David and I, we kind of like developing a trade, just a really simple trade, where when you do see market buys, and I was explaining this yesterday to B, when you do see market buys, how do you see a market buy? I'll give you an example. So like all of these candles, these with these wicks on top, they're market buys. These are market buys. And so people are just buying on market, and then you get these wicks. And then when you see these market buys, what you often get is for the price to fill the wick. So we had, like, you see this green candle here, that's like a market buy. It's like I'm bought on market. The price I bought all the way up to 5.4 excuse me, but the price closed back down at 4.2. But what you end up with is the market trying to fill the wick, and so the price goes up to try and fill the wick. You have to bear that in mind, and it works on every time frame. So now that we're looking at the weekly time frame, surprise surprise, we're trying to fill the wick. This is quite a long wick. It goes all the way up to 9.2 cents, but the price is trying to fill the wick. That's the first thing the price tries to do, is to fill the wicks. And that's just a common behavior on all charts. And so here in the past, if you look at this market sell, the price, what it did is it actually went down, it filled the wick, and it started to come back up again. And then you had this market buy here, and naturally the price went up and it filled the wick before it came back down. So when you understand how the price is behaving, then it can help you to determine where and when you're going to be looking to skim and to re-add. And the wicks are quite a good indication of how to do that, because the price is always trying to fill the wicks. It's always trying to. So that's something else to kind of think about. And then the other thing that I wanted to like describe is, like, people are saying to me, maybe, where can I put orders, like limit orders, like forget about them. And as I was describing earlier when I was talking about Bitcoin, as the price creates candles, you're also creating future order blocks. They're called order blocks. And basically, order blocks are good places to put your limit orders, right? And every time frame has order blocks. And obviously, the higher the time frame you choose, the more powerful they're going to be in terms of the strength that they give you. And then the other thing to consider is, as time passes, the stronger they become, as long as they're not reached. Yeah. So I'll give you an example. So like on the weekly time frame, yeah, we had this red candle created here. Yeah. And then the price reversed to go up with these three green candles. Right. So this red candle that formed before the price reverse has now become our weekly order block. The whole of the red candle from the tip to the toe, from the top of the wick to the bottom of the wick, is your order block. Yeah. So if you can imagine the price here, I'm putting it on the edge of my screen so you can imagine that there's no future price, and we're in the week of the end of October, then you're thinking, well, where is a good place to put my order? And it's this red candle here before the price reversed. And what people will do is they'll look at this candle and they'll ladder in on that candle with their orders. And they'll start at the top of the wick, the top of the body, and then maybe fibs all the way down the body, or maybe just 50% at the bottom of the body and then at the bottom of the wick. So they might have 5 orders there: top of the wick, top of the body, halfway through the body, at the bottom of the body, bottom of the wick. Or they may draw a fib extension and take it from the top of the wick to the bottom of the wick, and then the fibs in the body. So all of them, 382, you know, the 5, which isn't a fib, which is halfway, the 618, you know, whatever. And they'll just ladder in their orders on those blocks. And then in the future, when the price comes back, this is where the orders are. And the behavior is that eventually what happens is the price will come back. You see this? And so what has actually happened, potentially, is that the price came in and started filling orders as the price came back into this red candle, and it started filling orders until it couldn't get any further down because there were just too many orders and the price reversed. Yeah. So naturally, if you had laddered in on this candle, not all of your orders would have filled. That's also what's going to happen, depending on how bullish or bearish the price is. But that is naturally a good way of entering limit orders, just looking at the price, seeing where the previous red candles are, and laddering in your orders on those candles. Obviously, the higher the time frame, the stronger the orders. And then now going forward in time, if the price was to return back down to this level, all of the orders in this block are cleared up to the point where the wick arrived. So you wouldn't then put orders back on the top part of this red candle because it's already been cleared by this candle, which is wicked down in the top part of this red candle. The orders, the untouched orders, will begin underneath this wick all the way down to the bottom of the candle. So basically from this line down to here, this area here. This top part is now cleared. So you wouldn't put orders back where the price has come back to take those orders. You wouldn't put them back in that same position. No, that's not the correct behavior. And so naturally, if the price was ever to come back down, it may come back down through the wick, but then it will start hitting orders as soon as it gets to the bottom of this wick into the rest of this order block. Yeah. And as time passes, and people are looking to enter, you'll start getting more and more orders placed on these higher time frame order blocks as time passes. So right now, someone is looking at the price. They're like, we're like 10 weeks or whatever in. And then they're looking and they're going, well, look, if the price ever does get down here, I'm going to start putting my orders here. They'll start putting orders here. So ideally, in time, you'll get more and more people getting more interested into this token. They'll be like, well, there's going to be more and more orders placed on that lowest order block first. Yeah, there's going to be more demand there as there's more interest in this token. There's no reason why the price is going to return, but you would expect that as time passes in the highs, then if in the future the price was to come back down, it'd be a crap load of orders down there to gobble up the price. And you may get the same kind of behavior where the price can only get down a little bit more before the orders reverse the price. And then the other kind of behavior you will get, and you have to be aware of this, is that eventually with certain kind of places like here, people will front run the price because they definitely want to get filled. And that's when you get a situation where you get higher lows, or when the price wasn't able to go down to take the liquidity below this wick. So for example, in the future, I don't know how the future is going to play out, but let's just say for the sake of this example, the price does go down, God forbid. But I mean, if it does, then it's another opportunity to buy cheap tokens. Not a big deal, but let's not contemplate it for now. You obviously have this liquidity level here with the order block underneath it, where the larger portion of the orders are going to be. But someone is thinking to themselves, wait a minute, I don't really mind getting a slightly higher price just to make sure that my position is filled at those low prices. And so what will happen is they will front run these levels, and you'll get people laddering on the wick instead, the actual wick that leads into the block. Yeah, just because they want to front run the price, just because they want to make sure that they fill. Yeah. And that's when you'll get a situation of potentially, I'm not saying it's going to happen, I don't know what's going to happen, but I'm just giving you this example that the price can come down and it won't actually get past this level because it's just too many orders that are front running the price, because people know that they may never get filled if they just leave their orders here, and so they'll ladder in a bit early. And so as you look back in the price, now I'm looking at the weekly time frame, I'm seeing where the red candles are exposed. So that would be the first place that I would look to place orders. So if you see here, this green candle goes down to this level here, and there's a little bit of this red candle exposed, where the candle hasn't come back down, you're going to find orders there. Then this other part of this red candle is exposed, you're going to find orders here. Now you see in this candle here, this green candle has gone down all the way past this red candle. This is when I talk about swing failures. This is a swing failure where it's cleared all of the orders on that red candle. Yeah. So you wouldn't place an order on that red candle because this green candle has cleared the orders from the red candle. Yeah. And the strongest order blocks, the strongest ones are going to be the ones where the price has actually reversed. So you see here where you have these two red wicks, although this is MEX. I know that candle that was green on the gate, but whatever. This is an example. The price hasn't actually reversed here. It's still going flat to go up. The strongest ones are going to be where the price is going down and then up, like down and then up, where the price is actually reversing. Yeah, these are like continuation order blocks. And actually, so when you look at all the time frames now, so go to the daily now and looking at the previous red candles, starting with the current price action, start where we are now. And people are thinking to themselves, well, where can I place orders? Where's a good place to place an order? Well, if you look at the red candle in the previous price action, the nearest one is this inverse hammer, this red candle here. That would be your first place to place orders on that red candle, and you would ladder it in from the top of the wick to the bottom of it. The best price is obviously the bottom, but you may not fill, and that's the reason why people ladder in, because they want to be filled and they don't mind if the price kind of comes down, fills some of their position and not all of it. They're not too fussed. Yeah, because they have a best average entry. It's like dollar cost averaging in to the price as the price comes in to the order block. But the strongest level is obviously probably going to be where this flat happens, where the price closes on this daily and it opens on this daily candle. That's and it's called the daily level. So what I would do, and I learned this from somewhere else, it's not I haven't made this up, is I would put a line on that level and I would name it daily because it's on the daily time frame, and it has its own color, and that is a level to be defended. And that's also a level where orders will be, the most orders will be on some kind of retracement back down to that level. In the same spirit of the same idea, you're going to have a daily level above us too. So if you see how the price has gone up and reversed, and you have this daily close here and open there, this green candle closes and this red candle opens and the price comes down, you also have an order block there in reverse. So this is a sell block. And so if you were looking to sell, that would be your level, that green candle. Okay, so this is something to bear in mind as well. So effectively what you're doing is you're creating level, the structure is creating levels as new candles are being printed, and you can go back as far as you want. So there's another order block right here, this red candle, the whole candle has been untested, this whole red candle. Yeah, this one here. And you could, there could be orders there. That's where the orders would be. It would be on this inverse red. I like these inverse red hammers because they tell you something. Oh, look, inverse red, inverse red. See, that's an untested daily level, and you would expect there to be orders. And if they're not, that's where you'd place your orders. You'd place your orders here. You'd place your orders here. And as you work your way back in the price, you can see other levels. So there is another daily level, but this has been, the liquidity from this level has been taken. You see the wicks go down. They've cleared the liquidity from that daily level, so you just ignore it. And you have another one here, but you see the liquidity's been taken from that candle, almost all of it, with this wick down. You see that? So it's actually gone into that daily level. The orders have been filled at that price, and the price has gone up. So it's shown very good support at that level. There's a fraction of orders remaining there, so it is a little bit still remaining potentially underneath this wick on this exposed red. And As you work your way back, I can see that they're all being cleared. Even this one, you see how this wick went down. The order block was this red candle here. This was the daily level. The price went into that, cleared all the orders, and it came back up. And so the next untested one lower down is here. And then lower down, it's here. And then lower down, it's here. And then lower down, it's here. And then obviously you can go even further lower down to these areas here, all the way down to the lowest one. So what you end up with are lots of lines, and every single line that I've put here right now is an untested daily level at a place where you would expect people to begin to put their limit orders. These are the best places to put your limit orders, these on the daily time frame, right? And every time frame has this idea. So this is the daily time frame, and the weekly time frame, you're going to find the same idea, but the weekly levels are stronger than the daily levels. Yeah. So looking at this chart, I can tell you that there are weekly levels here. So there's one there. You see that red candle and then that green candle where it closes and then opens, and the price hasn't come back down, so it hasn't gone back to clear the liquidity. So that is your weekly level, and you'd mark it. I have a different color and I have it marked weekly. And so when you get a daily level and a weekly level together, that's even stronger, especially when it's untapped. Yeah. So just bear that in mind. This red weekly candle, see this green one cleared the whole of the weekly candle. And then you have this red candle. So basically underneath this daily candle, no, actually this is cleared too. You see this green candle? So actually the next weekly order block is all the way down here in this red candle here. And actually another strong weekly level, if it was to ever get down here again, would be there. See where this red candle closes, this green candle opens. Actually this whole red candle is the weekly order block, but on the weekly time frame you see the candle has come down to clear almost a third of it already. It's come down to clear it up to there. So this is cleared. So then you have orders down here on the rest of that candle, right? So this gives you an idea of liquidity in the market. Hold on. Oh, I haven't read these messages quickly. Oh my God. Craig Shot Gaming says, I think all arguments between SEC and Coinbase are today, so that could initiate a market move. Hodl Travel. R3A, hello. How are you? I'm well. I'm just going over some things. So, but the before yesterday's red was filled, wasn't it? Yesterday's red. So let me look at the date. Before yesterday, no, this red is still unfilled. So the price hasn't come into this red candle. That's your order block there. Hasn't been touched. At the moment, it looks like it's coming to touch it, but it hasn't been touched. Now, could that be because the price is front run it? Or could it be because the price is still looking to come back down? We don't know. But I just want you to see how the price moves. And at every time frame, you're going to get order blocks. And obviously, the higher the time frame, the stronger the order blocks. I only mark out daily, weekly, monthly, and above. Yeah. But just to give you an indication of the way the structure of the market has formed, it's formed creating a shitload of liquidity levels where orders can be placed without tapping those levels. Yeah. This is really, dare I say it, bullish, but it is bullish because the price is going up without the need of going back down to capture more liquidity. Yeah. And it's going up with volume. If it was going up without volume, then I would be a lot more concerned, like really concerned. Like I would almost expect it to go back down to test. Because it's going up with volume, that's healthy, and that tells me that it is possible that we don't necessarily go down all the way back down to test these liquidity levels, but these are where the levels are. And when I said that it was healthy for us to go up to clear the liquidity, that's what I was saying. I was saying that, look, on the way up, you have a sell, you had a, I'll show you, I'll mark them all out so you see how much liquidity has been taken on the way up. So there's a daily level there, there's a daily level there. This whole green candle, and this one is a sell block. Yeah, I'm not marking it now, just telling you where they are. And that, you see this daily level, it's been tapped, but the exposed, you see the exposed green candle here, this exposed green candle, that's the remainder of the order block. So it's still, even though the daily level has been taken, that's where most of the orders would be. There's still orders there potentially. Now, I'm not saying that people are that smart and they're placing their orders at these levels, but when the price moves, this is how the price moves. It doesn't really matter. Now, maybe it's just the computer bots that are doing this. I don't know. I'm just showing you how it works. So there's another daily level. There's another daily level. And you have the remainder of that wick all the way up to that top level, which I don't mark that as daily. I always mark these as swing failures. So liquidity levels at the highs. Basically, technically, they're sell stops. I have a mark for it, sell stops, but I'll just press F. Yeah, you see sell stops. And so when you look at the way the price moved up, you see that it went through 1, 2 daily levels, but it still hasn't been able to reach these levels higher up. And on different charts, it's slightly different. So like on MEX, it went all the way up to here, and on other charts, it went all the way up elsewhere. But then also when you look at the weekly levels, you can see that on MEX, these 2 daily levels also correspond to a weekly level. So that was quite a strong level, and I did mark that out in previous analysis. And you'd think that that's bad, but it's not bad. It's just you have to clear the liquidity. So these wicks that go up is clearing previous liquidities, so that the next time it goes up, there's less resistance, because now the liquidity is cleared. There's no more sell orders preventing the price from going up. And then the next weekly level is up here with the daily level. Now, usually when they're together, I just leave the higher time frame one and get rid of the daily one. And just generally, the weekly ones are going to be more resistant or stronger levels than the daily ones. And obviously these ones, now that they're washed, even though they may still be relevant, they're less relevant. So you would probably just ignore them, unless in the future you saw the price started to still react off them, and then maybe you would put them back. And so that's kind of where we're at now in terms of the daily and the weekly levels. And then obviously you can do exactly the same thing with the monthly time frame. Now look, so this is quite interesting. So we have a monthly time frame. We have a level down here with all of these dailies. This is untapped. And you could probably just remove all of these dailies, just have the monthly. The monthly is really strong. And when you're looking at these candles, you can actually see that this monthly red candle has not been cleared at all. So if you were to put orders, you could put it on the whole of this red candle. This is the monthly time frame. I don't know if the price is going to come back. I can't tell you if it is or if it isn't, but I do know that's the best place to buy is this red candle on the monthly time frame. Yeah, it's just the way it works. And in the future, if the price moves up and we do get another red candle followed by another green candle somehow, then you'd form a new monthly level higher up, and then that would be your nearest closest monthly time frame order block closest to the price as the price continues to move up. So that's why as you create these kind of candles, these red and green candles and structure, it's very kind of bullish. And that's kind of what we want to do. We want to create that because it allows for people to be able to place orders, limit orders. So that's the monthlies. And obviously on the way up, you have this. So this is interesting. So I actually think possibly that this monthly level has been tapped already. So you would expect it to be quite a strong level here. But I think you could, even though you can look at this candle and say, well, it hasn't quite reached it, I would consider that reached. Yeah, I would consider that a tapped level, a washed level. But obviously as you go higher up, you can clearly see that there's one up there. That's a monthly. And then obviously in the highest place, all the way up there. You see that? And that's how you can chart your charts and create the levels. And you can actually, so let me just put all of this stuff into, what I do is I put these all into a group. I call it, rename higher time frame levels. And then what you can do is, let's say you want to start just laddering in on the daily time frame. Bro, please look at Gary Token. It's a great project. Bro, your subscriber base will increase if you read comments on live chat ASAP. It will help you a lot. All right, I'll bear that in mind. You want me to have a look at Gary? I'll have a look at Gary in a second. Okay. Let me just finish this. So people are looking to enter and they don't know where to enter. Well, based on what I'm saying, looking at these previous red candles on the time frame that you're looking at are the places to enter for longs, and then obviously the places to enter for dare I say shorts, but sells would be previous green candles. So you see how the price came up to create this green candle. It came back down. As the price comes back up, it finds resistance back in the candle because that's where you would place your orders. Yeah. And maybe I need to explain this again, or maybe I need to explain this live. I don't know, as it's happening. But right now, like and every time frame has its own kind of candles. But when you see like expansive moves, so let me go to the 5-minute time frame. Let's say on this really expansive move, we were looking to catch it. Rather than buy the pump, what you see is as the price goes up, you form red candles. Yeah. See that? And so naturally, the best place to enter your orders are these red candles. As the price comes down, it comes back in, it finds support on these red candles to go back up. Like when you want to place limit orders, as the price is moving, look at the previous candles, and that's where you would want to place your limit orders, on these red candles, so that when the price comes down, if it finds enough limit orders, it will go back up. Yeah. Obviously this didn't continue, and it's really liquid, so that's why it's very difficult to to give it. On Bitcoin it's a lot easier to show, so maybe what I'll do I'll show on Bitcoin one day. All right, so I think what you want to do is bear that in mind. Don't miss out on the FOMO. The FOMO is going to come in the highs. The higher it gets, the more FOMO people will have, because here I am now where the price is at 4 point something, telling people this is a good buy, and you know, this is the strategy and these are the levels, and like just basically laying it out for people. People don't really have to do any work. They can just look at my charts and go, okay, I get it now. And then, but they won't act. And then one day in the future, the price of TRVL is going to be like 40 cents. And then they're going to be thinking, so, well, this guy's actually been saying that it's going up to $23.50, or maybe I should buy some. That's what's going to happen. You'll see. So just wait for it. Gary, R3A, are you still here? Gary token. Right.